Welcome back to Helping Make Sense, where we try to simplify the world of finance so you can be more equipped with power and knowledge to navigate your own personal financial life. Today we're going to talk about how to start investing. Seems like a simple question, but it can get pretty big pretty quickly. So before you actually start investing, it's super important to make sure you have a starter emergency fund, at least $1,000, maybe two or three. Because life happens, as we know. Another thing you want to make sure you don't have is any high interest debt, things like credit cards. If you do, your money's going to be more powerful paying that high interest debt down rather than investing. We can talk about percentages and how much you'll get in the market versus against some debt. A super majority of the time, the way you want to go in order as far as your personal financial life is eliminate high interest debt, things like credit cards, get that budget nice and stabilized, and then we can get into investing. As far as a place to start, retirement accounts are a great way. You've probably heard of things like 401ks or 403bs, which are employer-sponsored retirement accounts. If your employer offers a match, meaning that if you put in a certain amount of money as their employee, they will also put in a percentage, please take that match. At least that is literally free money. So if you put in 6% and your employer matches up to 6%, you have already made 100% on your money because they are putting in money to your account because you are doing the same. Both you and your employer are investing in your future. When you choose to contribute into your company-sponsored retirement plan, like a 401k or a 403b, they may give you the Roth option as well. So you have a 401k or a 403b, and then you might have the option to choose Roth or traditional. A Roth goes in, it's earning money after tax, and it grows tax-free. And then when you take it out in retirement, you do not pay taxes because you've already paid them when you put the money into the account. For a traditional 401k, you get a tax break today, and then it grows and is invested over time. And then when you take the money out in retirement, then you pay taxes on it at ordinary income. If you're asking yourself, should I do Roth or traditional for my employer-sponsored retirement plan? What's important is that you're doing it. You may even have the option to choose both because we don't know what the tax rates are going to be at the time of our retirement. They could be higher, they could be lower. Generally speaking, they go up, but when you're looking at it big picture, the more important element of this whole discussion is that you're actually putting money into your 401k, your 403b, and your IRA, which we'll get to in a second, rather than just not doing it at all. The Roth versus traditional, the only thing that represents is, am I going to take a tax break now, or am I going to take a tax break in the future? Roth is when you take a tax break in the future. Traditional, you take the tax break now. You may have also heard the term Roth IRA or IRA. It's literally the exact same idea. It's just that an IRA is not offered or sponsored by your employer. They're on their own. You can get them on the open market, but it follows the exact same process. In a traditional IRA, you can put money in and you take the tax benefit today. For a Roth IRA, you put in after-tax dollars, and then you pull out the money much later, and there is no tax on it. As far as the actual investments in any of these types of accounts, so 401k, 403b, IRA, Roth IRA, etc., keep it simple. The personal finance industry can seem very overwhelming, very intimidating. Don't feel like you have to choose an individual stock or you have to choose the right time when to get in. Even the best in the business cannot do this, and for those that are, it's probably their full-time job. So we don't want the average person focusing on picking the right stock or timing the market at the best entry point. The best thing you can do is look for low cost, what are called index funds, ETFs, or mutual funds. What they are is they're collections of companies rather than one big one or two big ones, because what if that big company goes under? Well, so does your retirement, and we don't want that. Another way that you can make sure you're getting the market at its highs and its lows, because obviously we always want to enter low and, see the market go high, is to just make sure you're investing consistently, whether that's once a month into an IRA or every paycheck, every 2 weeks through your employer. As long as you're putting money in, you're going to get it when it's up, you're going to get it when it's down, which is what's called dollar cost averaging, meaning that you're not going to buy it at one point and then wait to sell it. You're going to buy it at a bunch of different points, and it will average out at a certain what's called cost basis. If you feel like I want to start but I don't have enough, honestly, especially if you're young, any amount is worth starting. Even $20, $25 a month. If you build that habit, you start to kind of train that muscle and flex it. When you grow and hopefully your income grows as well, you can gradually increase your monthly or biweekly contribution so that over time, that money has compounded and grown for you. And more importantly, you've built the savings rate habit, making sure that you're putting money into your investments and into your retirement so that the future can be big, bright, and beautiful for you. If you're a psychological investor, if you have this kind of self-awareness about yourself and you would see headlines, or maybe you work in that industry and where you have to be subject to social media a lot or TV a lot or what have you, and you see these headlines of market downturns, impending wars, etc., you might be inclined to sell or make a move. I would strongly recommend that you don't follow the headlines as closely, because we want to, when it comes to investments, set it and forget it, right? Put that automated contribution in, whether it's through your company payroll or an automated deduction into a Roth IRA or something like that every couple weeks, every month, whatever. Set it and forget it. Let it grow. The market will increase over time. And I would encourage you to trust that even when the day-to-day headlines can seem a bit daunting. If you have maxed out your 401k or 403b, and you've maxed out your Roth IRA or IRA, and again, there are IRS limits on this, so please make sure you double check what those limits are so that you can get the most out of them. The next step after that would be a taxable brokerage account as far as investing your money. If you're at that stage, you would probably want to talk to a tax professional, a financial advisor or coach, just to determine how to best optimize the buying and selling within that account, since it is subject to more taxes. The main thing in all this is to be a successful investor, it doesn't require you to read all companies' public filings, be a Wall Street expert, know what IPOs are coming out, or picking the right funds. I do recommend you do some research so you understand what you're investing in. That's always very important as well. However, if you feel confident with creating an account or using the one your employer offers that is retirement focused, right? IRAs, 403bs, Roth 401ks, etc. If you can leverage one or more of those and put as much in as you can and feel comfortable doing, your future self will thank your current self for investing in your future. Because again, it doesn't take a lot of expertise, knowledge, research to know what you're investing in. It just takes some basic knowledge and research, and the behavior is what truly drives these outcomes rather than the knowledge.